welcome back. I'm joined by Dominic Roberts, the Head of Corporate Affairs over at Adriatic Metals. Dominic, good to see you.
Good morning. Thank you very much.
I want to start things a little bit differently today with you guys. So, and if you don't mind, I just want to run through this list and then we'll go from there. So in 2017, you acquired the project. 2018, you listed on the ASX.
Yes.
2019, maiden resource and LSE listing. 2020, you published your PFS. 2021, your DFS, financing and started construction. 2022, you're fully permitted. And 2023, production commences.
Yeah.
You've basically done in 6 years what many take 20. How on earth did you manage to do it?
It's quite a journey, isn't it? A breakneck journey. I think there's probably 4 contributing factors to this. I think the first is location. We sit on the Tethyan Belt, which is an incredibly prospective part of Europe. There's been mining here since antiquity, since the Romans 2,000 years ago. It hosts a whole number of other tier 1 deposits, and it's a pretty good place to find a good asset. And also geography. We are actually in continental Europe. We're in a Western European country. We have infrastructure, we have electricity, we have access to well-educated young girls and boys who can come and join the team. And again, that's allowed some of that momentum. History plays in. This is a brownfield project. There was a mine here before. And like so many mines around the world, the mine there didn't close because it ran out of ore. It closed because of, actually in this case, the political and economic situation in Yugoslavia and then, unfortunately, the Civil War. And so, that sort of brownfield legacy has been available to us to use, including actually quite a lot of dedicated mine infrastructure. And Bosnia also is part of Yugoslavia. Yugoslavia was a non-aligned country. It didn't actually have access to Russia or to the Soviet bloc. It had to do everything itself. And there is a fundamental cultural understanding in former Yugoslavia, Bosnia, of actually the linkage between the extractive industries and manufacturing output, something that we're so divorced from in most Western European countries where we haven't got a clue where our phone comes from. They sort of get it. And that also plays into the relationship one can develop with the community. I think as it then developed, the sheer quality of Rupice actually allowed that momentum as well. I mean, this is one of the highest grade polymetallic deposits anywhere in the world. When we stopped drilling this after 2 years and put out our maiden resource, it wasn't because we'd run out of ore or run out of places to drill. It's because we already had an economically viable project after 2 years of drilling. And then the fourth one, which is the sort of the softer one in a way, is actually probably I'd describe it as shared prosperity. It's been working with our key stakeholders, which is the community that hosts us, the government of Bosnia who want this and recognise the potential, and indeed our shareholders. And actually making sure that from the go-get and throughout and going forward into the future when we start production, that we maintain that sort of shared prosperity. So I think it's those 4 ingredients that have sort of baked this extraordinary cake that we're sitting on now.
Well, remind us of the actual project itself, because obviously, like you said, it's polymetallic, right?
Yeah. So
what are the main commodities that will be driving this? And can you give us a bit of a reminder of the actual size of the deposit and potentially the grade as well? You mentioned a very high grade deposit there. So what does the actual ore body look like?
The Rupice deposit is a VMS style mineralization. It's, just putting back a second, we're located in Bosnia. Vares, our local municipality, the town is about 55 kilometers to the northwest of Sarajevo, linked by fantastic roads straight down to the airport. And the deposit Rupice itself is about 10-15 k's up in the mountains above Vares. The Yugoslavians had actually sniffed this out towards the end of the 80s, and they had early indications of it. And that's why we acquired the project in 2017, because those indications were there. And then actually we moved on to our discovery hole, which was one of the highest grade polymetallic intercepts anywhere in the world. We hit 64 meters of 34% zinc equivalent on the first hole we put. Yeah, exactly. It comes in. And so on our maiden resource that was published in 2019, we had 9.5 million tonnes of indicated and 2.5 million tonnes of inferred, giving us a sort of 12 million tonne resource. But more importantly, coming into the reserves that we've taken forward in our DFS, and there's actually quite an engineering point here. In our PFS, this is a barite hosted deposit. And in the PFS, we still presumed that we would be able to market the barite. Barite goes into oil and gas drilling. It's used as a mud. And there is a market for it, but actually between the PFS and the DFS, oil and gas exploration started to slow down. The barite no longer became economical. And so what we did between PFS and DFS is we called it a bridging study, where we really looked at execution risk, at actually what things that we need, where we were carrying risk in delivering that shared prosperity and the return to our shareholders for all the trust they put into us. And we took the quite bold decision. We took barite out of the flow sheet. There was a precursor pyrite circuit as well that we removed. We actually changed the whole tailings velocity and went to backfill, reducing the impact on the surface. And those things significantly de-risk the execution risk. They allowed us to really simplify up the processing flow sheet. But the other big one we took out is that part of our historic resource we had in 2019 was the old mine that had been mined by the Yugoslavians. And we had broadly 4 million tons of resources there, but that was lower grade. It's a different deposit to Rupice, and traditionally it had high mercury. And we don't want to be producing a high mercury concentrate. It's not part of our story. We don't want to be dealing with that. And so whilst we have a resource on that still available to us, we took that out. So in the 2021 DFS, we went in with 7.3 million tons of reserves at 485 grams a ton of silver equivalent. Now, if we go into a bit more detail, across that 7.3 million tons, that's 200 grams a ton of silver, just under 6% zinc, just under 4% lead, 1.9 grams a ton of gold, and 0.6% of copper. So grade is king. We have got plenty of grade. And the other point I'd like to point out here is that we are sort of as a company internally hedged against any real possible sort of economic future. And of course, we're sat here today in London in August facing potential financial Armageddon with all the news coming in. But we are an asset that is going to produce broadly 50% of its revenues from base industrial metals and 50% from PMs. So there's a degree of sort of internal hedging with our metal mix. Yep. And in a bit more detail, it's 35% zinc and 35% silver, depending where the prices are. It is a polymetallic. They are variable. We all know this, and we know that full well. We have completed nearly 4 years' work. The way to deal with the variability is by adopting a geometallurgical approach. We have completed 4 years of geomet test work. We have a really clear idea of our ore body and of the different ore types, the domains, and how they're going to perform under processing, which has allowed us to inform our mine plan. It's allowed us to inform a stockpiling strategy so that we identify different styles of ore, different domains, bring them up on the stockpile, and as required, blend them to make sure that actually our processing plant, as much as possible, is de-risked from the inherent variability within the ore body so that we can do what our off-takers require, which is produce consistent, stable concentrates.
If you don't mind me cutting in. Yeah. So obviously, we'll go into more of the operational side in a moment. Yeah. But so large resource, very high grade, lots of exposure to different minerals, which, like you said, rightly so, hedges you on the precious and the base side, depending on economic uncertainty and certainty sometimes. So that's good. You mentioned a DFS there last year, and obviously I've seen the DFS. I know how good it is. I just remind us, obviously it's one of the lowest all-in sustaining costs projects globally. Can you just remind us of the actual post-tax numbers and the price assumptions that you used? Yeah,
so the DFS was published in October 2021. I quite like to use the word captivating. The figures are pretty cool. We have an internal rate of return of 134%. This is a over $1 billion NPV8 project. The capex, 168.2 million. And that's 168.2 million for an underground 800,000 ton a year operation. It is a low capex. Yep. Because this is a brownfield site, mostly. We have roads, we have electricity. We have a dedicated railhead at mine site that will take our concentrate straight down to main port. And those are big ticket capital items that many projects have to deal with, whereas we've already, from our history and from the operations that happened before, have that very low capex. Once we get up into full operating capacity, say we'll commission in the spring into the summer of late year, start production at the end of Q2. We've got a 6-month ramp up throughout next year, but into full operating capacity in 2024 and beyond, this thing produces over $200 million EBITDA a year. And in the first 5 years, there's $1 billion of cash flow produced out of this project, which, as I say, I think that, those are quite captivating. They're quite meaningful sort of figures.
Yeah, no, absolutely. One of the things, obviously, they are great figures, but we are now in an inflationary environment. We're seeing a lot of existing producers misguidances, and I guess one of the things that investors might have a question around is obviously you've raised your money for your capex that you're building at the moment. How might the inflationary environment affect your existing capex to get into production? And is there a contingency that you've already planned for, baked into that? And how might your all-in sustaining costs next year be affected by these inflationary pressures?
I mean, it's the question of the day, isn't it?
Yeah.
Of course it is. I mean, I think in some ways we were quite fortunate. We published our DFS in October 21. And of course, we used contemporary pricing at the time, and we used pricing for diesel, steel, electricity, concrete, etc. at that point. But very shortly after that, as we were moving into the very detailed engineering design, the world started to go, the problems started to accelerate at a point where we hadn't yet committed to some aspects. So right in the start, over the winter last year, we were able to design out some of our exposure. And I'll give you an example there. Steel, Bosnia imports steel. It is exposed to that dramatically. Inflation in Bosnia last month is at 13%. But we were able to design out the steel and put concrete portals and frames into our buildings instead. And that was it wasn't because we're amazing. It was a very fortuitous piece of timing. Why is concrete actually still relatively well priced in Bosnia? Because electricity is well priced in Bosnia. This is, I never thought I'd sit in front of you actually being pleased that we have a coal-based electricity system. Of course, in the future, as a company, we are committing to net zero and how we will approach that. But today, in the world we're living in, the fact that we have a vertically integrated government-controlled power system from state-owned mines all the way up through the power stations to the grid means that the Bosnian government has actually been able to keep a cap on the electricity prices to pre-2022 levels. So we're not exposed on electricity. Concrete, therefore, is also not inflating because a lot of the costs of that are from electricity. Diesel is the largest inflation we've seen, and we are burning a lot of diesel. We do have a huge amount of earthworks to do. The topography at Rupice is challenging. We need to create pads for our surface infrastructure. We need an actually very large ROM pad, ore pad, so that we can store those domains. And we're moving hundreds and hundreds and hundreds of thousands of cubic meters of soil to do that. In last count, there was something like 48 excavators on site. And diesel has gone up manifestly because Bosnia has no organic, it has to import it. And we have seen that come through. What we have done is we conducted about 3 months ago a very nut and bolt review of our earthworks. We have to move, we're clearing an awful lot of topsoil. We have to grub out trees, topsoil, clays, overburden. Each of those has to be stored in different locations. Each handling event from a pickup, from a front end loader into a truck and out again costs about $1 a ton. And we did a very detailed sort of time and motion study, and we managed to remove a number of handling events, which has brought our diesel costs down actually substantially. Notwithstanding that, yes, we are seeing inflation. We did a budgeting exercise in line with our 30th of June quarterly activities report. It's on the website released to the markets. At that point, we had 62% of our total capex was already committed. Okay. So that's over 100 million already committed. Now that's either invoiced or purchase agreement agreed, but committed. So if you look at the balance of that, and anyone out there can apply any inflationary figure they want on that, you'll see that actually even in your worst possible scenario, we still actually are not exposed to an awful blowout. And today, from that exercise, we're looking at actually using the retained contingency coming out at about 2 million over our original budget. So we're forecasting 170 million. And that will still leave us working cash for the first months of operation. And we still have a $7.5 million exploration budget in there as well. Looking forward, yes, our all-in sustaining costs are one of the lowest in the world. We're at $7.4 per silver ounce. That will be affected by the diesel price to a certain extent. It is difficult not to see that there'll be some sort of labour inflation. Good, frankly. When we actually started to put together our HR program and we went out and looked across all the contemporary operations in the regions and did our salary comparisons, we actually took a deliberate policy then to pay our staff more. It's part of this shared prosperity. We need to keep these guys. We invest time and effort into them. Let's look after them. And frankly, if price inflation means they get paid a bit more, it's okay because we've got so much margin in this project. This grade is so high at Rupice. And the OPEX costs are so low, there is margin in here really to deal with But I can't think of a scenario that actually blows that margin. So I think we're still looking pretty good on that.
That is very important. I mean, we were just doing an interview earlier, talking around more PGM markets, but notably Sibanye have had to reduce their forecast for that exact reason, unable to find skilled workforce. So if you're going to be committed to that and investing into that, I personally think that's a great thing. Let's have a look at how you're actually going to build this thing. Obviously, you're in construction at the moment. You obviously need a complete different skill set from exploration development, which you have been for the last 6 years or 5 years or so, to now a company that's actually going to be operating and producing metal. How much in-house experience is there in actually producing and operating a mine? And will you be operating this in-house, or have you found an external partner to actually operate this?
Good question. I think you talked about the exploration team. I'll give you an example here. And of course we have the exploration team in place, and they're still exploring because we've got a very large land package, and that team is working furiously on that. But it's quite a good example. Our exploration team today actually only has 2 expatriates in it. At the start of the operation in 2017, when we put together, it was mostly formed of expats because the company's philosophy is skills transfer. That's what we've got to do here. Bosnia also, as I said at the start, it's not a well-known mining jurisdiction, but there has always been mining in Bosnia. And there are mining colleges, there are geological universities, mining universities. Even in the high schools, there are mining courses provided for sort of 16 to 18-year-old children. So there is that sort of strong background. And also, by the way, a fantastic education system in the country. But what we are missing in Bosnia, perhaps, is exposure, particularly over the last 20, 30 years since Yugoslavia finished, to some of the progress that was made in the rest of the world. So our philosophy on this is to bring in expatriate skills and expertise, to bring in best practice. And we've got expats from Australia, South Africa, America, UK, all the jurisdictions one would expect. But their job is to, frankly, make themselves redundant. It is to pass across that expertise to actually very well educated, bright staff who have got a fundamental understanding from the education they received in that country already. And that is the way we're doing it. We've gone further. We sponsor a mining course in our local high school. We're now in a triumphant agreement with the Mining University and the Geology University. We're actually building graduate accommodation. And from the start of next year, we'll be running a graduate program with 20 graduates a year cycling through, as well as part of building actually what's going to be a future mining industry. There's more deposits in Bosnia, and there'll be more. Yes, we have outsourced the mining. The main mining contractor is a Turkish mining group called Şifte. Şifte incredibly experienced in the region. They're running 7 mines in Turkey itself. Critically, they've worked on EBRD, European Bank projects. Yep. So they're aware of the requirements of the EBRD's performance requirements. I didn't mention earlier, but EBRD are a shareholder in us. So we are actually in a legal environmental social action plan with EBRD to do things properly. And it was a very big part of our tender for the mining contractor to have someone that knew how to work to that standard. But the other thing is that Şifte are on a contracted drawdown of their internationals over the next 5 years, with a staged drawdown each time of swapping out the internationals to the local staff.
Good.
I think the other thing I say, we have a determined board committed policy of 25% female workforce, which we're tracking across the board. That goes from our non-execs through the execs all the way down into our local staff. And sat here today, we're at 65% local, the balance internationals. And we report on that on a monthly basis of tracking where that balance is. But the key point to answer your question is skills transfer, because our guys are capable, they're bright, they want to do this. They just need that little bit of help, and then once they've got the bit between their teeth, they're going to take this on and run with it themselves. Good.
You've already mentioned that one of the next questions I wanted to run through with you was actually relations in Bosnia, especially host community. You've mentioned there are a lot of different schemes and investments that you're putting into the host community, so I assume relations there are pretty good, but I wouldn't mind hearing a little bit more about that. And secondly, how are things with the government there, and what's the current geopolitical situation in Bosnia?
It's a slightly sort of backwards answer. We don't talk about ESG. We talk about sustainability. Okay, governance has to happen, otherwise your company's going to fail. Yep. And if you look at things in an E and an S, that's sort of in that little silo with the divisions between them, and where things fail operationally is where you have a division between something. So we, as a company, talk about sustainability. That goes back to my point about shared prosperity. When we permitted the project, we completed the Bosnian environmental impact assessment. And of course, we were issued the permits. But we then voluntarily did an internationally compliant ESIA. And the difference there is the S, actually, in that one, whilst I'm talking about silos. But it involved 2 years of social interviews, of really developing a very in-depth understanding of what our community wants and needs and requires, so that we can actually work with them to do that. And that journey has been, we're incredibly proud of the journey we've been on so far. One of the principal problems with our local community is that when the original mine stopped 30 years ago, we went from a town of 20,000 people to today a town of 5,000, albeit growing as well, our operations increase. And a lot of the feedback we got from the community is that actually give us a mechanism to stop our children leaving.
Yeah.
They're bright kids, but they go to Germany, they go to Austria. And this is exactly what we're doing. So we talk to them, find out what they need, find out what they want. And I think that has been a standout success actually for Adriatic, and for us it's what we want to do and create as part of our brand, is that level of community relationships. You're not patronising them, you're not simply putting money into the football club and all these sort of old-fashioned ways of doing it. You're listening to their unique requirements and then working with them. So stepping forward now, we've put in place a community development plan that's actually mostly focused on embracing entrepreneurial potential. Bringing them access to microfinance, to credit. We've got courses going on now, English language training. We have business plan courses. We've introduced the relationship managers from all of our key banks actually into the town. And we're seeing budding entrepreneurial. We're seeing, with the influx of new workers, the increase in the services that are required. Shops are opening, restaurants and cafes are opening, because that potential's there. And also in terms of government, it's that idea of shared prosperity. Bosnia is not a terribly well-known country, or rather it's known for probably the wrong reasons. But again, it's a government that actually wants to get on and do things. There's a very strong international community support to them as well, particularly actually we see from the British Embassy and from people like EBRD helping government. And again, if you work with all of them together, listen to the advice of EBRD, listen to what the embassies are saying, go into government, actually say, well, what do you want us to do? How are we going to do this? That's how you permit in 2 years. I mean, it helps that this project is huge. This project makes a manifest difference to GDP. I think it's 1.6% of the country's GDP will be increased by this project, with 25% of FDI this year. Now that gives us a seat at the table, but that doesn't give us carte blanche to behave however we like. But I think again, to recognise the relations of the government permitted in 2 years, we also have we've had 6 concession agreements. Effectively exploration licenses. We sit on the largest exploration land package that's ever been issued in the company, and that doesn't happen unless there's some trust in place between you and government.
Just before we move on to my final question, but you always hear about the negatives in mining ore. You definitely do a lot more, but it's the small things like the shared prosperity in regions like this, and being able to help the local communities that I think most people in mining, I think, really get a deep sense of satisfaction from. So I'm glad that you guys are doing things the right way. But let's look forward, and this is obviously more about the investment appeal of Adriatic, right? Obviously, there's a huge appeal in what we already have, but what's the corporate strategy going forward? It sounds like there is potential for exploration upside, so I wouldn't mind hearing about that.
Yeah.
And is there opportunity for M&A in the region?
We've got 3 corporate objectives. They're pretty clear and they're pretty simple. The first is generate near-term cash flow. Okay, this Rupice is a company building mine. So our absolute focus and priority at the moment is frankly returning the trust from government, from our community and our shareholders. Returning that by delivering this mine on time, on budget, and start producing that. And that is absolutely our principal focus. With that mine up and running, when we went through the economics, the cash that this puts out gives Adriatic, with hopefully a strong track record of doing something right in a European country. I think that gives us an awful lot of opportunities to look across the rest of the region. Yeah. The next corporate objective there is actually, to your point on exploration, is to extend Vares's mine life. Okay, Vares is approaching a tier 1. and we're going to get it there, but we've got some work to do. We're sat at 10 years life of mine now, but there is significant upside potential. When we stopped drilling at Rupice to put our MRE out, as I said, it wasn't because we'd run out of ore. It's because we had such a viable ore body that we didn't need to keep going. Rupice is open to the south, down dip, and critically to the north. In October last year, we started some step-out drilling to the north. The ore body did pinch out, and we lost it for about 80 metres, and we got it back again. And what we're seeing in the northwest, we've already released a first set of exploration drill results. It's thickening. We're seeing very high-grade intercepts, similar to what we saw in 2017-18. And there are already strong indications on that northwest extension of significant life of mine improvement there. It's only 80 metres away. From the underground infrastructure on the main mine, that is not a huge development drive to get into this next very high-grade ore body. We've also come to the end, actually, of a nearly 6-month-long confirmation and definition drilling program on the main Rupice ore body, where we've been able to convert an awful lot of inferred to indicated. And we're aiming to produce a revised resource and reserve statement at the end of the year. And there are indications within that as well as giving us a very clear guidance on our first 2 years mine operation from that drilling program. But actually, there will be more life of mine in that as well. So I think I'm signaling that towards the end of the year, we'll have another step from what we've just got at Rupice, but we've got the 42 square kilometres. We've done the area geology, we've mapped it, we've flown it. There's a lot of historical records as well. There's even historical resources within our land package. And we've got half a dozen drill-ready targets that look like Rupice repeats that we'll now start to be able to flick onto. So, am I dreaming about a tier 1 deposit? Yes, clearly, that's our job. But it's not a wholly unrealistic dream. And so I think in terms of that, extend Vares mine life, I think in the operations this year and a new reserve and resource statement, we'll be able to have achieved that. And then we'll be able to start flicking our drill rigs out into the wider area. And we've got years and years of drilling to be done there. So to your final point, the third corporate objective is the M&A. It's that we're ambitious. We want to be a homegrown European miner. Okay? But there's a reason for this. And we've all seen it happening. The world was changing 4 or 5 years ago, but it has accelerated dramatically. And then Ukraine has just times it by 10. We're in a world that's deglobalizing. We're in a world of resource fragility, resource scarcity. I was in Brussels the other day talking to the European Union. They're currently considering policies on subsidized smelting capacity in Europe. They're considering actually how to require the member states. Europe has realized that we can no longer actually go away and exploit other people's resources and leave our manufacturing base exposed to the supply chain chaos that's going on. Put quite simply, we need European mining. And what we want to do is be a company that's shown that we're capable of doing it in a European country, with all the potential of it going wrong in Europe, with very well educated, informed local communities who will pick you up the second you do something wrong. And if we can get it right in Bosnia, then yes, absolutely. And we are looking across Europe. We're going to focus on base metals, precious and the sort of critical transition metals. I don't think it needs to just be EU or continental Europe. I think we can look at friend-shoring, near-shoring events. I think we can look around the peripheries as well. But fundamentally, we will be moving into an M&A phase. We've got so much cash coming out of this budget. As well as discussing our dividend policies going forward, actually that cash needs to be turned around into the future. And that is, in our view, a multi-asset, diversified European mining company.
I hope we look back in a few years' time and see this as an inflection point of you guys getting there, because it sounds like you are on your way to being I don't want to speak too soon, but potentially a mid-tier, maybe even looking forward, major diversified, and it's an exciting time.
I've got a few years left. Yeah. We're going to get there.
Good. Dominic, great to see you.